Namaste everyone, welcome to our YouTube channel. I'm Pooja Sharma, and in today's video we are going to understand an important concept which many people have been requesting us to make a video on, the concept of return on equity or ROE. It is an important profitability financial ratio. Note that I didn't just say financial ratio, I said profitability financial ratio. Now, if you want to skip this introductory part and directly know what ROE is, then skip to this timestamp. But if you would like to enhance your knowledge about financial ratios, then stay back with me and we'll get to the root of this. First, let us see what is a financial ratio. Financial ratios are basically numbers that help us understand the performance of a company by comparing with its previous year's performances and also with other companies in the same industry. The theory of financial ratios was made popular by Benjamin Graham, who's also known as the father of fundamental analysis. Now, the financial ratios can be divided into four types. Number one, profitability ratio. Number two, leverage ratio. Number three, valuation ratios. And number four, operating ratio. For today's video on ROE, we are going to concentrate on the first type, that is profitability ratios. Profitability ratios, as the name suggests, assess a company's ability to earn profits from the business operations, balance sheet assets, or shareholders' equity. It basically indicates how efficiently a company is able to generate profits for its shareholders. Now, we have 7 types of profitability ratios to analyze a company: operating profit margin, gross profit margin, pre-tax margin, net profit margin, return on asset ROA, return on equity ROE, and return on capital employed, that is ROCE. Now, if this entire background is clear to you, let's quickly jump on to the next section, that is the concept of ROE. Okay, when one starts a business, they need to put in some initial capital from their own pocket, right? Along with it, they can also borrow money from friends and family and can also take a loan from bank. This initial capital that you're investing from your own pocket is known as the equity share capital. Now, if you've been running business for quite some time now, you would have earned some profit, right? Now, even after taking out some of that money to take care of the business expenses, you will be still left with a balance which you will be investing back into your business. Now, this money comes under your cash reserves and surplus, which you will use to run on the day-to-day business operations. Now, this equity share capital and the cash reserves and surplus together will make the common equity. Till now, we have covered equity share capital, we have covered cash reserves and surplus, and common equity. Now, when starting out, in exchange for the money that your friends and family lend you, you decide to give them a special equity. For now, just know that this special kind of equity that you're giving them is called as the preferred equity. This preferred equity is different from the common equity. I will be making a separate video on preferred equity for you guys. So now, this preferred equity along with the common equity together will make the total shareholders' equity of a company. Now, to find out the ROE of the company, we just need to use this formula. Dividing the company's net income, that is profit, after all the expenses have been deducted from the revenue, with the shareholders' equity will give you ROE of the company. The higher the ROE, the better it is for the shareholders. Why? Because if the ROE is high, it means that a good amount of cash is being generated by the company. But, that doesn't necessarily mean that it is the only ratio you should consider. The reason being, the ROE of the company can be easily manipulated by its management. How? Let's see with a quick example. Okay, now let's assume that Parry runs a bakery shop, and to bake cakes he needs an oven which will cost him rupees 10,000. He procures the oven from his own money and seeks no external loan for it. So in his balance sheet, on the asset side, he will have rupees 10,000 in the form of oven, that is the only asset in the business right now. And on the liability side, he will have shareholders' equity of rupees 10,000. Now let's try to calculate ROE in this case, and let's assume that in the first year of operation, he earns a profit of rupees 2,500. So the ROE will be 2500, that is the profit, net income, divided by shareholders' equity, that is rupees 10,000, multiplied by 100, and the resulting ROE will be 25%. Let's consider a second scenario. Everything is same, just that this time he only has rupees 8,000 with himself. Now, in order to buy an asset worth rupees 10,000, that is the oven, he will need extra 2,000. So what he does is he borrows those extra 2,000 from his sister, that is me. Now, let's take a look at his balance sheet. On the asset side, he still has that oven of rupees 10,000 in the form of asset. And on the liability side, now we have two components. One is shareholders' equity of rupees 8,000, that is the money he put into the business, and there is debt of 2,000 which he borrowed from his sister. Now let's try to calculate the ROE in this case. The ROE will be profit, that is 2500, divided by shareholders' equity, that is his own capital, that is rupees 8,000. And in this case, the resulting ROE will be 31.25%. So you see, with just an additional debt, the ROE shot up quite significantly. Now what if in the third scenario, he only has rupees 5,000 with himself and borrows the 5,000 from his sister, that is me, right? And the profit remains the same, 2,500. Now let's see his balance sheet. On the asset side again, he has rupees 10,000 in the form of a van, that is the only asset in the business right now. And on the liability side, he has rupees 5,000 in the form of shareholders' capital and debt of rupees 5,000. And what will be the ROE in this case? The ROE will be rupees 2,500, that is the profit, divided by 5,000, that is the shareholders' equity, multiplied by 100, and the resulting ROE will be 50%. So you can clearly see here that higher the debt Perry is able to collect, higher is his return on equity. Now you also understand that a high ROE is great, but not at the cost of high debt. The problem with high debt is that it will take just one recession or even a temporary economic downfall for all the businesses with high debt to shut down. Because if a business earns losses in any financial year, it is not liable to pay dividend to its equity shareholders, but it is most definitely liable to pay interest on the loan it has taken from bank or financial institution. And for this reason, inspecting the ROE closely becomes extremely important. In the next video of this Basics of Stock Market series, we are going to cover another financial metric to analyze a company. If you like the video, then give it a thumbs up and share this video with your friends and subscribe to the channel if you have not done it already. We'll be coming up with more such content for you all, right? And if you have any suggestions, then do let us know in the comment. We might cover that in the next or upcoming video. That's it. Bye bye, namaste, and take care.